In just 48 hours, Humana, a titan of the American healthcare system, saw its market value shredded. We're talking about a 21% single-day drop that sent the stock to a new 52-week low. For many, it looks like a disaster. But for the smart money, this might be the most aggressive mispricing in the healthcare sector this decade. Is Humana broken, or is it just on a massive temporary sale? Today, we're looking at why the market panicked and why Humana might be way undervalued. So what caused the carnage? It wasn't an earnings miss. It was a shock to the system from the federal government. On January 26, the Centers for Medicare and Medicaid Services, CMS, proposed a nearly flat 0.09% payment increase for 2027. To put that in perspective, Wall Street was expecting a hike of 4% to 6%. For a company like Humana, which is heavily concentrated in Medicare Advantage, that difference is billions of dollars in potential revenue gone in a heartbeat. But here is where the math gets interesting. Before the crash, Humana was already a stable, profitable machine. Now look at these metrics. According to several discounted cash flow models, the intrinsic value of this company is estimated at over $300 per share. Even the most conservative analyst price targets are sitting near $215, well above where we are trading right now. Why are contrarian investors stepping in? Three reasons. Overreaction. The market is pricing in the worst-case scenario for 2027, ignoring the fact that these rates are often negotiated or adjusted before being finalized in April. Operational strength. Humana's core business is still solid. They recently topped earnings estimates by 29 cents per share and are seeing 11% year-over-year revenue growth. Historical support. Every time Humana has hit this support zone between $185 and $205 over the last decade, it has historically bounced back with an average peak return of over 40%. Now it's not all sunshine. The risk is real. If medical costs continue to rise and the government keeps those rates flat, margins will be squeezed. Some analysts warn of a 15 to 20% hit to earnings if things don't change by April. This is a high-stakes game of chicken between big insurance and the Trump administration. Is Humana undervalued? Fundamentally, yes. It is trading at multiples we haven't seen in years. But in the short term, you're catching a falling knife. If you believe the Medicare Advantage model is here to stay, this might be the entry point of a lifetime. If you think the regulatory environment has permanently shifted, you might want to stay on the sidelines. What's your move? Are you buying the dip or waiting for the dust to settle? Let me know in the comments.